$750 billion. That's roughly what the largest technology companies plan to spend building artificial intelligence infrastructure in a single year, 2026. Data centers, chips, power. And almost all of it rests on one promise, that these machines will replace expensive human labor. Now here's the number nobody puts next to it. When you take the US government's own labor data and run the exact test an economist would use to find that replacement, the measurable effect of AI on employment, so far, is zero. Not small. Statistically indistinguishable from zero. $750 billion a year, priced against an effect the data can't yet see. That gap, that seam right there, is the most expensive misunderstanding in the market today. And for the next 40 minutes, we're going to live inside it. Here is the claim this video is going to make, and it's one no other channel has put in quite these words. The story you've heard everywhere, that AI is killing entry-level jobs, that a degree stopped being an insurance policy, that the class of 2026 is the first casualty of automation, is not yet visible in the primary labor data. The softening that's real, and it is real, looks like an ordinary economic cycle. And confusing those two things, a cycle and a revolution, is quietly costing investors and workers a fortune. I want to be precise about what I'm not saying because this argument gets misread instantly. I'm not saying AI will never transform work. I'm not saying the graduates struggling right now are imagining it. I'm saying something narrower and far more defensible, that as of today, the fingerprint of AI displacement is not in the data, and that there is a rigorous way to tell the difference between a signal and a story. So, here's the journey. First, history. Two separate strands of it because this exact panic has happened before, more than once, and it left a pattern. Then the primary sources, the actual government data, and the test that pulls the signal out of the noise. Then a financial model you can run yourself. How big is that seam in dollars? And finally, 3 things you should do differently, whether you invest, hire, or are trying to get hired, starting tomorrow. And why should you care which one it is, cycle or robot? Because the cause decides the money. If it's a cycle, the Federal Reserve cuts rates and the slowdown turns. If it's AI, no rate cut on earth fixes it. Same jobs report, 2 opposite futures, for your portfolio and for your career. Getting that one fork wrong is the most expensive mistake in the market right now, and almost everyone is making it on autopilot because the story is louder than the statistics. Every argument about technology and jobs eventually reaches for history, and most channels use it as decoration, a sepia photo of a factory to make the point feel deep. We're going to use it as evidence. Because the question isn't, has automation ever destroyed jobs? It's sharper than that. When a general-purpose technology arrived and everyone predicted mass unemployment, what actually happened, and on what timeline? We're going to answer that on 2 separate tracks, the history of business and the history of computing itself, and crucially, we're going to mark exactly where each pattern held and where it broke. Start with the cleanest, most counterintuitive case in the whole file, the automated teller machine. In the 1970s, the ATM looked like the end of the bank teller. The machine did the teller's core task, dispensing cash, faster, cheaper, around the clock. The prediction was obvious and unanimous. Tellers were finished. The opposite happened. The economist James Besson documented it. Because the ATM made running a branch cheaper, banks opened far more branches, and each branch still needed people. The number of human tellers rose for about 2 decades. The lesson is the one the whole video turns on. Automating a task is not the same as eliminating a job. When the automated task makes the final product cheaper, demand for the human work around it can expand. And the numbers are almost comic in hindsight. As the count of ATMs in America climbed from about 100,000 in the mid-1990s to roughly 400,000 by 2010, the number of human tellers didn't fall. It held steady and even rose, hovering around 500,000. The machine built to end the job spent decades growing it instead. What changed wasn't that tellers stopped counting cash. It's that counting cash stopped being the job, and helping customers with everything a machine couldn't became the job.
But here's where the analogy breaks. Teller employment eventually did fall, and an ATM automated exactly one task: cash. Generative AI takes aim at a whole bundle of tasks at once. They open more branches. Escape valve may simply be narrower this time.
Second case, and this one is about time. When factories electrified, roughly the 1890s into the 1920s, the productivity boom everyone expected didn't show up for something like 30 years. The economic historian Paul David explained why. The gains didn't come from swapping a steam engine for an electric motor in the same old building. They came from reorganizing the entire factory around distributed power, moving the machines, redesigning the workflow, rethinking the floor. The technology was ready decades before the organization was. That's the deep pattern of every general-purpose technology. The payoff waits for the reorganization, and reorganization takes a generation of managers, not a product cycle. Put dates on it because the lag is staggering. Electric motors were available from the 1890s. By around 1919, only about half of American factory horsepower had gone electric, and the great manufacturing productivity surge didn't really arrive until the 1920s. That's a gap of roughly 30 years between the tool existing and the tool paying off, and the entire delay was human. It took a generation to figure out that electricity meant you could tear out the central steam shaft and lay the factory out around the work instead of around the power source.
Except, rewiring a factory was physical and slow. Software spreads through a download. The reorganization lag that took electricity 30 years could, this time, compress into a handful. That's the strongest card the pessimist holds, and we're not going to pretend otherwise.
Third case, and it lands closest to home because it's white collar. In 1979, VisiCalc, the first spreadsheet, automated precisely the entry-level task everyone assumed would gut the accounting profession: the manual recalculation of ledgers. Later Lotus, then Excel. And yes, the low-rung jobs, the bookkeeping and ledger clerks, declined. But the number of accountants and auditors grew. Because once modeling got cheap, it became worth doing constantly for more decisions at more companies. The routine task got automated, and the humans moved up the value chain from mechanical work to judgment work. It's the ATM pattern again in an office. And the scale is the point. Since 1980, the United States shed roughly 400,000 bookkeeping and accounting clerk jobs, and added about 600,000 accountants and auditors, the people who use the tool to make judgments. The task died, and the profession grew at the same time, because once modeling costs collapsed, the appetite for analysis exploded. Every business could now afford to ask questions that used to be too expensive to answer by hand. The tool didn't shrink the work. It multiplied the demand for it.
The break. AI may climb the value chain faster than displaced workers can retrain to stay above it. Move up only works if there's time to move.
And behind all three cases sits a single recurring mistake, 2 centuries old. The Luddites smashed looms in the 1810s, believing the machines had stolen a fixed quantity of work. The same fear returned in the 1930s, the 1950s, the 1980s, every generation convinced that this time the pie of human work would finally stop growing. Economists call it the lump of labor fallacy, the assumption that there's a fixed amount of work to go around, so every machine permanently subtracts a human. At the aggregate level, it has been wrong every single time. The pie kept growing in ways nobody could forecast. That doesn't make it impossible for this time to be different. It just means the burden of proof sits squarely on whoever claims the displacement, not on whoever expects continuity. Now the second strand, because this exact fear has a history inside computing itself, and it rhymes almost word for word. Rewind to 1964. A group of scientists and economists sent a memo to President Johnson warning that cybernation, their word for automation plus computers, would create a permanent army of the unemployed. Machines would take the work, Humans would be left idle by the millions. It didn't happen. Employment kept rising for decades. The prediction wasn't stupid. It was serious people reasoning carefully. It was just early, and it overshot. Which is the pattern. The automation panic reliably arrives before the data and reliably overshoots it. And this wasn't a fringe pamphlet. The memo was signed by figures including the Nobel laureate Linus Pauling and the economist Gunnar Myrdal, and delivered to the White House with real institutional weight. In the 4 decades that followed, American employment didn't collapse. It grew by tens of millions of jobs, right through wave after wave of computerization. The smartest people in the room, reasoning carefully from real trends, called the top of human work, and were early by more than half a century, if they were right at all. That is the humbling base rate every AI jobs forecast has to beat. Push back even further to 1958, and the rhyme is already there. When the perceptron, one of the earliest neural networks, was unveiled, the New York Times reported the Navy expected it to eventually walk, talk, see, write, reproduce itself, and be conscious of its existence. Around the same time, researchers were confident that machine translation would make human translators obsolete within a few short years. The capability was going to arrive any moment now. Then reality showed up. In 1966, a U.S. government report known as ALPAC concluded that machine translation was slower, less accurate, and more expensive than a human being, and the funding collapsed for the better part of a decade. Human translators stayed in demand for another half-century. The lesson isn't that the skeptics are always right. It's that the announcement of obsolescence has consistently run years, sometimes decades, ahead of the arrival of it.
The honest caveat, they were wrong before, is an inductive argument, not a law. A technology general enough could be the first real exception. Past false alarms don't guarantee this one is false too.
Case 2 on this strand, and it's the most direct rhyme of all. In the 1980s, the hot technology was the expert system, software that encoded the knowledge of doctors, lawyers, engineers into rules. Japan launched its 5th-generation project in 1982, roughly 57 billion yen, about $400 million, chasing the dream of automating the professional class. The promise was explicitly white-collar. This time, the machines come for the knowledge workers. And then the capability underdelivered, the funding froze, and the field fell into what's still called an AI winter. The knowledge workers were fine. Not because the ambition was fake, but because the technology couldn't yet do what the narrative had already sold. The project ran for a decade and was wound down in the early 1990s, a commercial failure. Funding verified, yen 57B/$400M, MIDI, 1982, early 1990s. And notice exactly what the promise was, because it is word for word the promise you're hearing in 2026. Not the factory floor, but the professions, medical diagnosis, legal reasoning, engineering judgment. This time it comes for the knowledge workers, not the manual workers claim that feels so shockingly new right now was the confident headline 40 years ago. It stalled, and it stalled not because automating judgment is impossible, but because the capability arrived long after the story that had already sold it to investors and the public.
But here's the difference that should keep you honest. The 1980s systems mostly couldn't do the work. Today's models genuinely can clear a huge range of real tasks. The capability objection that saved white-collar jobs in 1990 is weaker now. So we lean on the measurement, not on the machines can't.
Third case ties the two strands together. Robert Solo's paradox, 1987. We can see the computer age everywhere, he wrote, but in the productivity statistics. For more than a decade, computers visibly transformed the office while the aggregate numbers refused to move. Adoption was obvious, the payoff was invisible. And then, in the mid-1990s, the boom arrived, and it was enormous. Which gives us the single most important rule for reading 2026. No signal now never means no signal ever. The absence of a fingerprint today tells you about the timing. It tells you nothing about the destination. Line them all up: 1958, 1964, 1966, 1982, 1987, and one number keeps repeating. The distance between when obsolescence was announced and when, if ever, it actually showed up. Years. Sometimes decades. That gap is the base rate you should carry into every AI and jobs headline you read this year. It doesn't say it will never happen. It says something more precise and more useful. The announcement is not the arrival, and historically the two are a very long way apart. Put both strands together, and the rhyme is unmistakable. In every case, business or computing, the panic came before the data. The real effect arrived on a lag measured in years or decades, and the first-order intuition, task automated equals job destroyed, got it wrong because it ignored what cheaper output does to demand. That's a powerful prior. But, and this is the channel's discipline, a prior is not a promise. The speed and generality of this technology are genuinely new. Software diffuses in a download, not in 30 years of factory rewiring, so the lag that saved every previous generation could be shorter this time. So we don't rest the case on history. We take history as far as it honestly goes, and then we go to the data. This is the part almost nobody does, because it's harder than quoting a headline. We're going to read the actual documents. Not the coverage of the data. And we're going to start by building together the test you'd need to catch AI displacement if it were happening. Because if you don't decide in advance what the evidence would look like, you'll just find whatever confirms what you already believe. Fingerprint 1. A divergence between occupations. AI wouldn't hit everything evenly. It would hit the jobs most exposed to what it does well, language and routine analysis and code, and spare the jobs that need hands and presence. So employment in high-exposure work should peel away, downward, from low-exposure work. Fingerprint 2, a jump in occupational churn, millions of displaced people forced to switch fields at once. Fingerprint 3, the finest among recent graduates, because companies cut future hiring long before they cut current staff, so the first damage shows up not in layoffs but at the bottom rung, in the 20 to 24-year-olds who can't get in. Sit with the logic of that third one because it's subtle and it comes back to haunt us later. A layoff is loud, and it gets recorded in the data. But a job that simply never gets posted, a role a company quietly decides it no longer needs because a tool now covers it, is completely silent. It shows up in no separation statistic anywhere, only as a slow, grinding difficulty for young people to get a foot in the door. So, if AI is going to bite anywhere first, this is where it bites, and it bites where our instruments are weakest. That's the strongest possible version of the case against my own conclusion, and I want it on the table before we look at a single number. But there's a trap, and it's why you can't just eyeball a chart. Exposed and unexposed occupations differ in a dozen ways besides AI, education, pay, how sensitive they are to a normal recession. So the honest method isn't a comparison, it's a technique economists call synthetic difference in differences. You build a control group that matches the exposed group on everything else, you subtract out the pre-existing differences, and only then do you ask whether AI exposure leaves a mark of its own. It's the difference between noticing two cars at different speeds and measuring how much is the engine versus the slope of the road. Why go to all that trouble? Because without it, you'll blame AI for a recession or credit it with a boom that had nothing to do with it. And here's the part that matters for trusting the answer. This method is deliberately built to find an effect if one exists. It is not a tool designed to reassure you. If AI were displacing workers, synthetic difference in differences is exactly what would catch it, and catch it early. That's the discipline the doom coverage skips entirely, and it's precisely why their conclusion and the data's conclusion end up pointing in opposite directions. When the budget lab at Yale ran exactly that test, here's what the documents say. The effect of AI exposure on employment and wages, close to zero, and statistically indistinguishable from zero. In their May 2026 work, they add a number that should stop you cold. The share of employment in the occupations most exposed to AI is about 0.16% of the civilian population. That's a tiny base to hang a macro revolution on. And be precise about what indistinguishable from zero actually means, because it's a stronger claim than small. It means the measured effect sits entirely inside its own margin of error. Statistically, you cannot rule out that the true effect is nothing at all. About 3.5 years after ChatGPT, using the sharpest method available, the honest scientific statement is not AI is slowly taking jobs. It's we cannot yet detect that AI is taking any. Those are very different sentences, and only one of them is in the data. Fingerprint 2, the churn jump? Not there. Workers are not switching fields abnormally. And the change in the mix of jobs that does exist is running only about 1 percentage point above where it sat during the internet's adoption at the turn of the century, a transition nobody remembers as a jobs apocalypse.
In a detail that Dune coverage never mentions. Much of that shift in the job mix was already underway in 2021, before generative AI existed as a consumer product. We're crediting the machine with a movement that started before the machine arrived.
Sit with that, because it quietly demolishes the coincidence argument that the whole narrative rests on. If the reshuffling of jobs was already accelerating in 2021, and generative AI didn't reach the public until late 2022, then AI cannot be the cause of the part that came first. A lot of what's now blamed on the machine is just the economy doing what it was already doing: remote work arrangements unwinding, pandemic distortions normalizing, a labor market finding a new shape after the strangest 3 years in its modern history. Correlation grabbed the microphone before causation could get a word in. Their bottom line, reaffirmed in their June 2026 tracker update, is blunt. The broader labor market has not experienced a discernible disruption since ChatGPT launched. Fingerprint 3, the recent grad canary, is the one place there's any movement, and we're going to be honest about it. The Budget Lab sees a slight upward drift in the dissimilarity between the youngest graduates and older ones, but it rarely leaves a narrow band, and the researchers themselves warn it may just be a cooling labor market, not AI. It's a weak, ambiguous signal. We'll come back to it, because it's the strongest card the other side holds, and it deserves respect, not dismissal. And here's the intellectually honest move that almost nobody makes. You don't get to keep the data points that flatter your thesis and quietly discard the one that doesn't. That recent grad drift is the single reading that could be the first whisper of the very thing I'm telling you isn't here yet. So we don't bury it and we don't explain it away. We put it on the dashboard, we set a threshold in advance, and we watch it every month. If it breaks its band and stays there, we will be the first to tell you the verdict is changing, and that credibility is worth more than being right today. So, if the AI fingerprint isn't there, why does the pain feel so real? Because the labor market genuinely is cooling just for ordinary reasons. The macro data says so plainly. Unemployment drifted up from 3.4% in April 2023 to the low 4% range by 2026 and sat at 4.1% in the July report, low, but no longer improving. And hiring didn't just slow, it stalled. In July, payrolls actually shrank by 23,000, an outright decline. Worse, the 2 prior months were revised down by more than 100,000 jobs combined. June alone was cut from 57,000 all the way to 20. This is what the end of a hiring cycle looks like, not the fingerprint of a robot, but the familiar shape of an economy running out of momentum. Around 7 million Americans were out of work, and wage growth had cooled to roughly 3% a year, soft, but not collapsing. And notice the shape of it. The unemployment rate barely moved even as hiring turned negative. That's exactly what a frozen labor market looks like: almost no one getting fired, but almost no one getting hired either. That's not a robot replacing anyone. That's a cycle running cold. And look at which numbers are moving, because it's diagnostic, it tells you the mechanism. In an AI displacement story, you'd expect a wave of involuntary separations, people pushed out as software takes over their desks. That is not what the data shows. Firing is low. What's actually fallen is voluntary quitting and new hiring, which is the textbook signature of a cautious, cooling economy, where workers stop job hopping because they're nervous and employers stop backfilling because they're uncertain. Every one of these fingerprints points at the same suspect, and it isn't the machine. It's the cycle, and the texture confirms it. The JOLT survey, the government's read on openings, hires, and quits, describes an economy of low hiring and low firing at once. A frozen market, not a collapsing one. Quits, the thermometer of worker confidence, have cooled. People are holding on to what they have. And in a frozen market, who suffers most? Not the insider protected by low firing. The outsider, the person trying to get in for the first time, punished by low hiring. That's the boring, well-documented reason graduates struggle in every slowdown. Last in, first out. Not because a machine took the seat, but because the door temporarily shut behind everyone already inside.
But what about all the companies announcing AI layoffs? Trackers now count AI-attributed cuts as their own category. Isn't that proof?
It's proof of something, just not what it looks like. A company has every incentive to blame AI for a cut that's really about a weak cycle, or overhiring in the cheap money years, or plain cost pressure. Where visionary and automating sounds better to the market than we overhired and misjudged demand. Declared attribution doesn't measure AI's effect. It measures how convenient it is to invoke AI. That's exactly the noise the Yale method is built to filter out, and when you filter it, the signal is still, so far, indistinguishable from zero. And there's a tell if you look at who's talking. The companies loudest about AI-driven cuts are very often the same ones that hired most aggressively during the cheap money boom a few years earlier. For a management team, where automating with cutting-edge AI is simply a far better story to tell the stock market than we misjudged demand and overhired, and now we're correcting it. The narrative launders an ordinary management error into a visionary strategy, and the market and the coverage mostly buy it without checking. Reading the announcement as data is how the story keeps outrunning the evidence. One more source because it cuts the other way, and we use it honestly. The Anthropic Economic Index shows real, rising, task-level use of these tools at work. People genuinely are handing pieces of their day to the machine. But read it for what it is, a measure of usage, not of net employment. High usage and zero measured job loss can both be true at the same time, and right now they are. That's the whole puzzle in one line, and it's the puzzle the model is built to price. And this is exactly the gap the biggest videos on this topic fall into. The gap between headlines announcing AI fails at 96% of tasks, a genuinely beautiful piece of narrative, and reality is that this narrative is not a measurement. Nobody in that lane separates the anecdote from the econometrics because the econometrics are slow and boring, and the anecdote is instantly viral. Our entire edge is being willing to do the boring thing on camera. Walk the method, read the filing, run the test, and then, unlike anyone else, put a price on the answer. Which is exactly where we go next. Everything so far has been diagnosis. Now, let's put a number on it, a model you can actually run, with the cells recalculating on screen, because unfakeable math is the whole point of this channel. We're going to build what I'll call the AI-Labor Wedge, the distance between the labor displacement the market is paying for and the displacement the data can measure. 3 panels. Watch the numbers move. Panel 1. Reverse engineer the assumption. Start with that cold open figure, roughly $750 billion in 2026 AI infrastructure spending. Capital spending like that only pays back if it produces something, and the headline justification over and over on earnings calls is labor cost savings, fewer people, or the same people doing far more. So ask the model a simple question. For that spend, plus the margin expansion baked into AI-exposed equity valuations, to make sense, how much human labor cost does the market have to be assuming gets displaced? Plug in conservative payback assumptions, and you get an implied labor displacement figure in the hundreds of billions of dollars a year. That's the number the price is quietly promising. Let's make those cells concrete so you can see the arithmetic move. Say the market wants that infrastructure to pay back over, generously, a decade that alone demands tens of billions of dollars a year in returns just to break even before a cent of profit. Now stack on top of it the margin expansion that AI-exposed software valuations already assume in their multiples. Add those together, and the model needs the technology to erase a labor bill running into the hundreds of billions a year, every year. That is not some fringe assumption hiding in a footnote. It is the bull case, written out in dollars, and once it's written out, you can finally check it against reality. Now drop in what the data measures on the other side of the cell. The Yale result, an effect on employment indistinguishable from zero, across an exposed base of about 0.16% of the workforce. The wedge, priced in minus measured, is almost the entire priced in number. The market isn't paying for a little optimism at the edges. It's capitalizing a labor displacement dividend that, in the government's own data, hasn't started. This is the same disease we've dissected in other episodes, earnings borrowed against a future that has to arrive on schedule. The wedge isn't proof the future won't come. Remember Solo, it came just late. The wedge is a measure of timing risk, how far prices run ahead of evidence, and therefore how much it costs you if the payoff lands 5 years later than the multiple assumes. And here's why the timing is the entire ballgame in numbers. A dividend that arrives on schedule is worth full price today. Take that exact same dividend and push it out by 5 years, Solos lag in miniature, and basic discounting knocks a large chunk off its present value, even though it eventually arrives in full. So the market isn't just betting that the displacement happens. It's betting on when. And the honest historical answer to when is later than you think, almost every time. The wedge is simply how much that lateness costs you, priced, not guessed. Panel 2 turns the diagnosis into a trade because the cause of the 2026 slowdown decides the whole macro path. Branch A, it's a cycle. Then the Federal Reserve cuts rates, credit loosens, the cycle turns, and the assets that benefit are the rate-sensitive ones. Duration, growth, the usual playbook. Branch B, it's structural AI displacement. Then you get disinflation that rate cuts can't fix, persistent slack in the labor market, downward pressure on labor's share of income, a completely different regime, and a completely different portfolio. And the two branches don't just differ in theory, they pay off in completely different assets, which is what makes getting the cause right worth money. In the cycle world, the winners are long-duration bonds and rate-sensitive equities as the cuts arrive, the labor market heals, and consumption recovers. In the structural AI world, you get sticky disinflation that cuts can't cure, a permanently softer labor share, and a narrow hunt for the few firms actually capturing the productivity rather than just spending on it, a totally different shopping list. Owning the wrong list because you misdiagnosed one jobs report is precisely how real money gets lost in plain sight. And you can actually see the disagreement, which is the beautiful part. If you back out what current prices imply, the market is putting real weight on Branch B, the structural AI world, right now, today, ahead of the evidence. The data, run honestly, still sits on Branch A. That gap between the market-implied probability and the data-supported probability is the single cleanest expression of this entire thesis. It's not that either side is insane. It's that price has front-run proof, and you can measure in basis points exactly how far ahead it's gotten. Here's the trap the model makes visible. Most investors are implicitly betting on Branch B, buying the AI displacement dividend, while the data currently supports Branch A. If you get the cause wrong, you misread the Fed, and if you misread the Fed, you misvalue every asset whose price depends on the path of rates. The wrong diagnosis isn't a nuance. It's two incompatible worlds priced as if they were one. Panel 3 is the stress test, and it's what makes this honest instead of just contrarian. What reading would prove me wrong? 3 gauges. 1. The exposure divergence. High exposure employment peeling below low exposure, sustained beyond a set threshold for several consecutive months, not one noisy print. 2. The recent grad gap breaking above its 30 to 33% band and staying there. 3. An occupational churn spike well above that internet era baseline. Cross those, and the verdict flips from cycle to the revolution is arriving, and the model swings from branch A to branch B. Until then, the data says cycle. And the wedge says you're being paid to notice that before the market does. And we pre-commit to those thresholds in public before the data comes in, so we can never quietly move the goalposts later. Something like high exposure employment running below low exposure by more than a set margin for at least 3 straight months, not one noisy print. A recent grad gap that pushes above 33% and holds. A churn index that jumps clearly above the internet era baseline. Writing the numbers down in advance is the entire difference between a forecast you can be graded on and a vibe you can always wriggle out of. So the model's output isn't a prediction, it's a verdict with an expiry date stamped on it. Today, on this data, it reads, cycle. Not forever. Just this month, on this evidence. Next release, we run it again, and the day the gauges cross, the verdict flips, and we say so loudly, in public on camera. That is the exact opposite of the permabear who's been right about nothing for a decade, and the permabull who will never admit a turn. We take a position, we date it, and we let the data itself fire us from it. Quick aside, and then straight back to the numbers. A one-time verdict goes stale the moment the next jobs report lands, so we don't do one time. We rerun this exact model every print and keep the live table and the tripwire dashboard in the newsletter updated the day the data drops. If you'd rather see the seam move in real time than read about it after it's priced, that link is below. So, what do you actually do with this? 3 implications for investors, for anyone building or hiring, and for anyone trying to read this economy at all. These aren't abstractions. Each one changes a decision you might make this month. Take the one that fits you and act on it. 1. Separate the 2 trades. The macro cycle bet and the AI displacement bet are different bets, and right now they're wearing the same costume. If you're buying rate-sensitive assets because you think the slowdown turns, that's branch A, a cycle trade, and the data supports it. If you're paying premium multiples for AI names because you believe they're already harvesting a labor displacement dividend, that's branch B, and the data does not yet support it. The mistake is buying branch B while telling yourself it's branch A. Know which trade you're in, and know which one the evidence is actually backing today. So here's the concrete exercise. Go through your holdings and, for each one, ask which bet am I actually making. A rate-sensitive position is a wager on the cycle turning. Fine, the data backs that one. A premium multiple on an AI name is, in part, a wager that the labor dividend is already flowing, and that one is running ahead of the evidence. You don't necessarily have to abandon it. But you have to know you're early, and size it like someone who's early and could be waiting years, not like someone holding a confirmed fact. Early and right still loses money if you're sized like you're certain. 2, and this one's for anyone entering the workforce or hiring into it. Treat 2026 as a timing problem, not a category problem. This field is dead, and this field is frozen for now. Call for opposite decisions. If you believe the field is dead, you don't train, you don't apply, you accept worse terms, and if the real cause was just the cycle, you've inflicted the damage on yourself. But respect the trap on the other side. If enough employers believe the entry rung is obsolete, they'll stop building it preemptively, and the belief manufactures the collapse the data hasn't yet produced. A market that stops making beginners stops making its future experts. Watch that reflexivity, don't feed it. And if you're the one doing the hiring, there's a longer game hiding in this. The entry rung isn't charity, it's the machinery by which your entire industry manufactures its future senior people. saw it off in 2026 to look efficient this quarter, and you've quietly guaranteed a shortage of experienced talent in 2032 that no amount of AI will be able to conjure in time, because experience can only be grown, not generated. The firms that keep building the bottom of the ladder while everyone else cuts it will simply own the next decade's talent. That's not idealism, it's supply and demand with a long lag, which is exactly the kind of mispricing this channel exists to find. 3. Stop reading the anecdotes and start reading the instrument. The headlines will always be louder than the data. That's their job. The 3 tripwires from the model are what actually matter: a sustained exposure divergence, a recent grad gap that breaks its band, a churn spike. Those are the numbers that would tell you the story finally became true, and they tell you before the coverage catches up. Anecdotes are how you feel informed. Tripwires are how you are informed. And this is the practical payoff of doing all of this the hard way. By the time AI displacement is a headline, it is already priced into the market. You're too late to do anything but react. The tripwires move first, in the dry government releases, months before the narrative catches up to them. If you're the one watching the gauges, you get the single most valuable thing there is in markets: a little bit of time. Not certainty, time. Time to reposition before the crowd finally agrees with you and moves the price. That edge, month after month, is the whole reason this channel exists. We started with 2 numbers and a seam between them: $750 billion a year, priced against a measured effect of 0. Now you know what that seam actually is. It's not proof the machines will fail. History says the productivity boom probably does come. It's the distance between a story that's arrived and a payoff that hasn't, and that distance is measurable in dollars right now. 2 strands of history told us the same thing. The panic always precedes the data, the effect always arrives late, and automating a task has never been the same as ending a job. The government's own test told us the fingerprint isn't here yet, and the model told us the market is paying anyway. None of that means relax. It means hold the instrument and watch the 3 tripwires, because the day that flat line starts to rise, whoever's been measuring the seam will know before anyone else. That's the entire promise of doing this the slow, rigorous way. Not a crystal ball, a smoke detector. We won't predict the fire, and we won't pretend to. We'll just be the first people in the building to hear the alarm, and we'll tell you the moment it goes off. And that's the whole channel. Every video, I take one number the market repeats on faith and show you what's actually inside it. If this changed how you'll read the next "AI killed the jobs" headline, subscribe. That's the promise, and I keep it every episode. And if you want the seam itself, this exact tracker, kept live and updated the day every new print lands, not summarized months later. That's what the newsletter is, the living version of what you just watched. So here's the question I'll leave you with, and I genuinely want your answer in the comments. If the signal does arrive, if that line starts to climb next year, do you think the market will price it in months early, or will everyone still be arguing about headlines the day the data confirms it? Tell me which and tell me why. I read the thread.